Alright, by the end of this video, you're going to understand what manipulation is, how to use it to your advantage, and what to look for exactly when price is manipulating a specific range, whether it be internal or external. So the main key for manipulation is you need to understand what it is and, more importantly, how to properly use it to your advantage. If you guys stick around and watch this video to the end, you might learn something that you've never knew before when it comes to trading that can change your experience when it comes to wins and losses. I just need y'all to do me a favor. Please tap that like button and subscribe if you're new to the channel. I appreciate you guys for stepping in and watching these educational videos that I give you guys for absolutely free. So when it comes to manipulation, we got to think of a few things before understanding how it works. One is, what is happening when price is manipulating, and what is manipulation to begin with? So we got to understand that when we zoom out to a higher time frame, we're always going to have a trend. We're always going to have a trend. There's going to be an uptrend, there's going to be downtrends, and there's going to be areas of interest where buyers or sellers push the market to up or downside to begin with. And the main thing we need to understand is that with a trend comes traders, buyers and sellers. So you need to ask yourself, what is getting manipulated here when we have quote unquote manipulation? And the answer is buyers and sellers. If we have a uptrend that shows we're pushing to the upward side, then that shows that buyers, people are taking interest into the market. And just like you, just like me, just like most other traders, these people are going to have stop losses. There's also going to be limit orders under areas where price did not go towards. So manipulation is price going in the opposite of the general trend's direction to liquidate the previous buyers or sellers in said general trend. So manipulation to a side that does not correlate with the general trend will generally stop out the previous buyers or sellers that took their trades within this range. And liquidating or removing buyers and sellers does not weaken the market, it actually strengthens it, because for every person that gets set out of the market, someone gets put into the market. There's two things that we need to understand. Not only does manipulation stop out the previous buyers, but it also gives people emotional standpoints to want to get into this downwards move or upwards move that does not correlate with the general trend. If you're seeing a good uptrend, right, and you're seeing prices pushing to the upward side, all right, you get into the upside here and you have a trade as a buyer, you take a long position right here. You have a take profit maybe above this range and a stop loss below one of these lows. Price just manipulates all the way to the downside here. As a retail trader, you might get fear of missing out, which causes you to re-enter in a opposite position, X, Y, and Z, and you just get in manipulation moves, and it's just a whole mess, right? But the key is, as a trader who's trying to be analytic and smart, you don't want to just get caught up in this manipulation. You want to find the best range to trade the manipulation, which is what I'm going to show you next. So there's two general types of manipulation that we can get in the market, and there's no way of determining which one is going to happen unless you see the next steps that I'm going to give you guys after explaining this. So external manipulation is price going below a external swing point before reversing to one side or another. As we can see in this example, we have a bullish uptrend. Price does external manipulation to a swing low where the bullish momentum started right here. And then we continue to the upside, breaking structure above this high right here. And this is a good example. Most of the time after we see external manipulation, price will do internal manipulation, which is a internal low within the external swing point ranges. So we can see right here, here's a internal low within the external swing point ranges. Price manipulates that after going above this high before continuing its general trend to the upward side. So external manipulation would be a external swing high or low given the general trend, and internal manipulation would be a internal high or low given the general trend. Obviously, we're generally bullish here. We can see it on the hour time frame. We're making higher highs and higher lows. So if we have manipulation, then we're expecting external manipulation to a low and not a high. And vice versa, if we're in a downtrend, let's find an example. Perfect. If we're in a downtrend here, you guys see this, we have internal manipulation to a previous high before continuation of the general trend. If we're pushing in a general downtrend, we're not looking for the lows to be a general sweep point. We're looking for the highs, whether it be internal or external, to be a sweep point. Sometimes there's going to be internal manipulation only. Sometimes there won't be manipulation at all. Sometimes there will be internal and external manipulation, but we need to make sure that we see what happens when price enters one of these lows to know exactly which area is going to be considered manipulation in the live markets. So what do we need to see to ensure that an area or range is going to be manipulation? How are we going to know which low is actually going to be swept before continuation? I want you guys to notice each of the lows that swept the internal and external ranges in this example. I'm going to zoom in and show you guys. When we swept this range in this example, there was only wicks, no body. Zoom over here. When we swept the internal range, there was only wicks, no body. And then we did it again and there was only wicks with no body candlestick. So I'm going to give you guys some areas that can help you verify if a external or internal range is actually a manipulation move or a liquidity sweep. And the first verification is that price only wicks under the low instead of putting a body under the low. So we see lines as I showed you guys in each example here. We only wicked below the low, showing a rapid reaction as soon as we touch the area of manipulation. And another thing that we can see is that when price attempted to retest the area after manipulating, we failed to go back into the range. And we can see this in every single example. We make a higher low after sweeping. We make a higher low after sweeping here. We can mark that out. And in this example too, we also make a higher low after sweeping. Here we go. Remember guys, the goal is not to top or bottom tick for a manipulation move so you can catch the best spot. You want to wait for the best steps possible so you don't get liquidated or manipulated. So the best keys that I have for you guys to verify if a area is going to be manipulation is 1, when price sweeps under this area, make sure that it's only wicks and no body. And 2, when we sweep the area, we should see a strong reaction and a failure to close below the range. So if we have a low where price sweeps liquidity, we should not see price attempting to go back towards the range where we swept a low. Or we might get something called a stop run, which is when price continues down in direction to take more areas of liquidity out. So you're marking out an external or internal range. You're waiting for price to wick below it. You're waiting for proof and respect, and you're waiting for failure to make a new low or high given the example. In the downtrend example I gave you guys, we actually did end up closing above the recent area of manipulation, but we can see that price reacts to it, and we also create a lower high from this range as well. The main general standpoint is that you want to see a external or internal range, given the example, be respected and not disrespected. So if we push above this liquidity and liquidate this previous high, then that means from this point we should not see a higher high showing a break of structure. We should see a lower high and a continuation of the general trend, which is bearish. And now you guys should know everything that's required to use manipulation to your advantage. I try to make it very simple and easy to understand. I try not to make the video too long because I know people don't like watching very long videos, but this should give you a very good explanation of what manipulation is, how to look for it, what to look for, and how you can use it to your advantage. All you really have to do is check the general trend, wait for price to manipulate below a external or internal range, and wait for the steps that I gave you guys. You guys can go to the 1 hour time frame to check the general trend. And then you have to use market structure and price action to see which internal or external manipulation range we're in. And after you see price enter a manipulative range, given the general trend, wait for respect, wait for proof, and take your entry. Trust this model, it works. And I'm here to help you guys if you have any questions about it. And now you should be able to understand the basics behind manipulation and how to use it to your advantage when trading in the live markets. Thank you guys for watching this video. Please do me a favor and hit that like button and subscribe. We're still posting videos on this page and I want to keep it going for you guys. So thank you guys so much. And as always, have a great day and let me know if you need anything.